weakness extends on the street with the benchmark now below the 24,000 mark and broader indices moving in tandem as the volatility index spikes. All sectors are in the negative territory with real estate, pharma, PSU banks dragging most. Autos hold on to minor gains.
Pharma stocks declined after Trump outlined a steep tariff roadmap for generic drugs with zero tariffs until 2028, followed by a sharp increase thereafter. However, analysts believe that 2 years is more than enough for players to build a manufacturing base in the US.
Bandhan Bank fell sharply despite reporting a 35% rise in June quarter profit as investors reacted to weaker guidance. The bank cut its FY27 return on assets outlook, ruled out any expansion in margins and cited higher funding and technology cost overshadowing stable asset quality.
And contrasting moves for the mid-cap IT stocks. Cyan DLM has surged after reporting a strong June quarter with profit more than doubling and margins expanding. Mastech, however, declined despite reporting an in-line June quarter as margin compression offset the steady revenue growth in the company.
Aavas Financials fell despite reporting a 23% rise in June quarter profit as margin pressure and a softer growth outlook weighed on sentiment. Mahindra and Mahindra Financial gained after delivering a strong quarter and reiterating a positive FY27 outlook.
Nestle India is expected to report a strong June quarter with revenues seen rising 19% and profit up 27% on a year-on-year basis. Growth is likely to be driven by double-digit volume expansion, strong exports and margin gains, helped by easing agricultural commodity costs.
Eternal is expected to report a strong June quarter with profits seen jumping over 70% sequentially. Growth is likely to be led by Blinkit's rapid expansion, strong quick commerce momentum and continued gains in food delivery.
Dr. Reddy's is expected to report a weak June quarter with revenue, profit and margins seen declining sharply on a year-on-year basis. The drag is likely to come from the high base of generic Revlimid sales in North America and semaglutide supply disruptions.
Hello and welcome. You're watching Buy Now, Sell Now. I'm with you, Kavita Thaplia, and with me is my colleague Meryl D'Souza. And next 1 hour is going to be all about your stock-specific question. And as we know that we are in the thick of the earnings season, a lot of managements are also going to be a part of this show where we'll be asking them questions on the numbers and also we'll be giving you a stock-specific strategy. But before that, let's shift focus on NIT, where in terms of result, if we just flash it on the screen as well, revenue up 14% year-on-year, EBITDA is almost we can look at 1.4 PAT. We are looking at 85% jump, but then EPS has also seen up move of 84%. We are also joined by the management, and let's get connected and start getting in deeper on these numbers. We are joined by Mr. Vijay Thadani, co-founder NIT Group and Vice Chairman NIT Limited. Hi, good morning, and welcome to the show. First up, consumer revenue growth. If we look at 27% up year-on-year, we can see a significant number over year ahead of enterprise. Now, how much of this growth is actually driven by one-off BFSI hiring recovery versus structural demand for AI and technology programs? Also, for the investors' perspective, should investors expect consumers to continue growing faster than enterprise over the next few quarters?
So first of all, again, I think you have two questions. So the first question was on consumer. And I think the consumer delivery is also coming from the strong growth that we are seeing in the university segment. We added a new member in our family last year, which was IM Neo. And I think they've done exceptionally well last year. And they are on a strong growth track, that team. On the other hand, the demand for AI-led courses, especially agentic AI and other AI fluency programs, they are also gaining momentum. You're right, BFSI hiring has picked up. and BFSI hiring is contributing part of that growth. Last year, BFSI hiring was at a negative, and therefore, to that extent, the delta is higher and in the visibility that we can see right now. But yes, BFSI growth is back, but not yet at the levels at which we are used to.
Right, sir. Meryl D'Souza also joining in. I'm seeing AI contributes around 9% of your revenues today. What milestones should investors track over the next 12 to 18 months in order to assess whether AI can become a meaningful growth engine for you?
Yes, I think the indicator that we have shared, I think, is a good indicator to share. The second will be use cases. I think we have some very interesting use cases like using an AI coach for helping wealth management professionals. AI coach, for example, in auto dealerships or auto sales, in making sure that with the wide range of vehicles that are available, how do salesmen become proficient in offering the right model to the right customer? So these are some use cases, and we can talk about use cases, and from there you could get an indication of what are the growth possibilities. But the two examples I gave you are definitely two of some of them which are gaining momentum. Forward deployed engineers in GSIs, for example, is a very high demand area, but also high specialization when it comes to building the training programs for that. I think NIIT is very well suited and placed there, given our vast experience, as well as the lead we have in building AI-led programs. So I think these are some of the indicators which will contribute to the thought process of how AI is affecting our business.
Right. Let's also talk about the order intake, which remains healthy despite a challenging environment. But, if we have to ask you to comment on the quality of these orders, what would that be? Also, what percentage of new orders are AI-led compared to a year ago?
Okay, I wouldn't have the breakup, but a large number of new orders are now AI-led. And when I say AI-led, I refer to AI fluency programs, very domain-specific programs. Like I gave you examples of auto, I gave you examples of banking, I gave you examples of GSIs. Similarly, GCCs have very domain-specific requirements. I think those are the programs that are gaining traction. And the fact that we are able to demonstrate outcomes, which is an improved capability, improved performance, I think gives us a stronger position in the market.
All right, understood. Operating expenses were also seen growing only 7% against the 14% revenue growth, which is resulting in significant operating leverage for you. Now, as revenue continues to grow, what is the sustainable EBITDA margin that your company can achieve over the next 2 to 3 years, which is assuming current investments are normal?
See, there are some parts of our business which are at near steady state margins, which will be between 15 to 18%. And there are others in which we are in an investment cycle, and then there are those which are affected by the environment. Well, all the businesses are affected by the environment, but in some, the AI penetration is actually helping us overcome that the environment effect. So the steady state margin that our business should be at is 15 to 18%. There are some parts of the business which are already doing that. There are businesses which actually do better than that as well, and that will get demonstrated. And to that extent, I think you should see an improving ratio between revenue and expenses, which means expenses are not likely to grow as fast as revenues. And we should see a steady improvement as we go forward. Of course, this has to be balanced by the investments that we are making, for example, in AI-led platform and product development, as well as go-to-market initiatives. But I think in the overall sense, our effort is to work on the margin also as we go forward.
All right, Mr. Thadani, thank you so much for joining us today and answering all the questions. So that was the management of NIT. But then let's us focus on Nestle's results that's flashing on the screen, and the stock is almost up 3.5%. Profit has come at 975 crores, almost a 47.7% jump that we can see versus 660 crores. And we are also looking at revenue numbers going up. Revenue has beaten the expectation. It's gone above that. Revenue is reported at 6378, which is 25.2%. Jump on the numbers that we can see, and healthy set of numbers so far, 6378, and EBITDA has come up to almost 1538 crores, which is up 39.8% as compared to 1100 crores, and EBIT margin is at 24.1% versus 21.6%. So on all parameters we can see the numbers beating the estimates. Margin has gone healthy, up 24.1%. Its domestic sales numbers is also looking good, 6,073 crores, which is a 25% up that we can see. There's also a quote that's come from Mr. Manish Tiwari, CMD Nestle India, and he's also saying that the operational cost savings have continued to set up investments behind their brands, with advertising spends increasing by over 40% and a healthy EBIT margin of almost 24.2%. PAT for the quarter stood at 975.1 crores. That's a 47.9% jump over the corresponding quarter. And in terms of product categories or product groups, all 4 product groups delivered strong double-digit growth, supported by high double-digit growth across channels. And the business performance is strong, and they remain focused on building the capabilities, partnership, and value chains that strengthen the business for the long term. But then our colleague Ashesha has also joined us with more details. Ashesha, Nestle Q1 results better than estimates?
Well, clearly better than expected numbers, and across all parameters, it's a beat. Revenue has come in at about 6,380 crores versus ET now poll of about 6,100 odd crores. So it's a beat on revenue front. It's a beat on margin front as well this time around, with EBITDA margins coming in at 24.1% versus expectations of 22.3%. Clearly, it's a big beat when it comes to margins. Now, remember, management commentary with respect to growth is also very positive. They've said that all 4 product groups delivered strong double-digit growth in the quarter gone by, and this was supported by high double-digit growth across channels. They've spoken about e-commerce, where they've seen sustained growth. Organized trade delivered strong double-digit growth across channels. And the commodity outlook, meanwhile, remains uncertain and mixed. That's the commentary that has come in from the management. We'll try and decode the volume figure with the analyst who is just joining us in a bit. But for now, across all parameters, it's a beat. Management commentary is positive. We don't have the volume figure yet, but otherwise, when we look at the numbers and the commentary, clearly it's a big beat, and that is exactly why the stock is now up more than 3% as we speak.
Yeah, Shesha, thank you so much. We're also joined by Kaustubh Pavaskar. He's the lead analyst, ICICI Direct. Kaustubh, hi, morning. Welcome, and your first take on the numbers, please.
Excellent set of numbers, beating our as well as street expectation on all front. Domestic sales growth coming at 25% is ahead of what we and street were anticipating at around 8-19%. So overall, we were anticipating somewhere around mid-teens kind of volume growth. I think volume growth, looking in numbers at around 25% growth, I think volume growth must be better than what we and street were anticipating for the quarter.
Also, in terms of product categories, all product groups have delivered strong digit numbers, high double-digit growth across channels also. Was that a concern for you, and is that a positive surprise?
See, expected impact. If you look into the food categories are doing much better compared to what the other category in the FMCG is. So I think Nestle last quarter they had delivered a strong performance. I think this quarter is ahead of what the last quarter performance was, and I think on the margin front, also their performance was much better than what we and Street were anticipated. So overall, it was a strong performance. I think this momentum should continue, unless there is any impact of higher inflation or any uncertainties on a commodity front. That could be a risk. But barring that, I think from the growth perspective, I think Nestle should continue to drive the strong growth, considering their strategies which are in place.
So Nestle continue to drive strong growth. That's the word. Thank you so much, Kaustubh, for taking your time out and talking to us on the results. And the stock is also up more than 3.5%. All right, with that, it's time for a short break on this edition of Buy Now, Sell Now. But then post that, we'll be joined by Anthem Biosciences Management to talk more on the results. Stay tuned.
Welcome back. You're watching Buy Now, Sell Now with me, Meryl D'Souza and Kavita Thaplayal, where we now have the management of Anthem Bioscience here to speak with us about their first quarter results. But let me first take you through the numbers that they've reported. So the first quarter has been sort of muted for Anthem Bioscience. Remember, it's a novel pharma drugs company, so the business is sort of lumpy over here. Revenues for the company have come down over 23% on a year-on-year basis. EBITDA seen gap down 22%. EBITDA margin as well has been muted. Very flattish moves on EBITDA margin, up only 51 basis points on a year-on-year basis, while net profit has been seen compressed down 12%. We have on board with us Mr. Ajay Bhardwaj, founder and chairman, MD and CEO of Anthem Bioscience, here to break down the numbers with us. Hello, sir. Very good morning, and welcome to you on Buy Now, Sell Now here at ET Now. We've just gone through your first quarter results, but before we get into the numbers, on this major pharma tariff announcement, I understand your company is a little bit away from that whole segment of pharma. This announcement is on the generic side of pharma. So can we conclude that this will not have any impact on your business as a whole?
Absolutely. The tariffs that have been announced are for the generics pharma industry, and we are not at all present in generics. Our businesses, and since we are still a newly listed company, people are still discovering that our business is for novel molecules. We have nothing to do with the generics. So this tariffs will not affect us in any way.
All right, but then in general, what's going to be the impact, tariff announcement impact on pharma space, if we want to understand from you?
We don't know. It could be turned back tomorrow. It's so ad hoc and erratic that's very hard to form a view on it. See, our customers, on the other hand, which are big pharma, largely when all our manufacturing is exported to big pharma, they all have actually made deals with the current administration there. So they're all tariff-free because they made separate deals individually with the current administration in the US. So even if tomorrow novel molecules are tariffed, Anthem will again be unaffected because our customers have all made one-on-one deals with the current administration.
All right, sir. Thank you for that breakdown about the tariff situation. But coming back to your numbers, I'm seeing first quarter was a little bit muted. And can you explain about what that was about and also about your order book position currently? Can you quantify how much of full year revenues does that contribute to your full year revenues?
Absolutely. See, the other parameter that we track very strongly is our order book, and we have more than 60% of what we need to achieve this year is our what we call work in progress, WIP, is still with us. It's confirmed orders. So I'm not breaking into a sweat over this quarter's numbers. Wait and see till the end of the year. Everything will be just fine. Over 60%.
Right. So what's going to be FY27 guidance over FY26 top line and also margin guidance for FY27 then?
So, we have said this before. growth will be in line with what we have delivered historically. This will be double digit in the teens, could be even better, but the margins will continue to be strong. We already have very strong margins. So, since our EBITDAs are in the regions of in the 30s, high 30s, touching 40s, and that will continue. And our PAT, because it's been 26%, 27%, and I don't see any reason for that to come down.
All right, so sustained growth in margins and PAT. But tell us about the 4 new commercial launches that you did in the previous year, that's FY26. How much incremental revenue will they contribute to your full year FY27 numbers?
So let me just first frame the discussion. A lot of our business depends on the projects which are in late stage, which is phase 3 becoming commercial. So last year when we went public last year, we had 10 commercial molecules which were contributing to our manufacturing sales. Now we have 14, so 4 new have been added. But the sales actually kicks in much later because these companies get invariably acquired by big pharma, which has also happened in this case. But it takes a while for them to reach peak sales. What the analysts have predicted for these 10 molecules is peak sales of over $10 billion, and which will be in the next 3 or 4 years. So as of now, we've got hardly any numbers contribution from these 4 new launches. But over the rest of the year, and certainly next year, we can hope to see contribution from these new molecules as well.
All right, one last question before we let you go, Mr. Bhardwaj. GLP-1 is a significant opportunity for you, and company is working with major customers to develop an India-based alternative to Chinese GLP-1 APIs. What's the update on this? Any progress?
Yeah, I mean, we're just waiting for approvals from Cisco, the regulatory body. Otherwise, we are completely ready. We have done all the filings, and once that happens, even our customers are ready, and I think we should be able to bring customers on board very soon once we have all the regulatory approvals in place. So it's just a matter of a quarter or two where we will be in the marketplace supplying to all the major players.
All right. Thank you so much, Mr. Bhardwaj, for speaking to us here at ET Now. And with that, viewers, we'll slip into a very short break.
Welcome back. You're watching Buy Now, Sell Now, and it's time to answer your stock-specific question. For all the viewers who've just tuned in, the WhatsApp number is flashing on the top of your screen. Note that down, write down the name of the stock, the price at which you've bought it, and your time duration, as per which we'll give you a technical or a fundamental take. Joining us are our guests on the show today, Nirav Vora and Lakshmikant Shukla. Hi, good morning. Welcome, both of you. And let's start with our first question. This is a WhatsApp query coming in from Ram Babu Sen. He's from Jaipur. Wants an investment idea for midterm or a 3 months advice. The stock is Vedanta Iron, and 35.1 is his buy price. Nirav, I'll come to you. A short-term take though, but what would you recommend?
We don't have active coverage on this particular stock, but overall, if you look at this particular space, we are quite, overall bullish from a 2-year kind of a time frame. So iron and steel as a space has gone through some consolidation of late. We have seen last couple of months have been a little disappointing as far as the metals as a overall pack is concerned, because dollar index has moved up above 100 levels and it's hovering around 101, which has an inverse proportion on the overall metal space. But having said that, we still feel that we have a good opportunity to buy all these stocks in the recent fall. So having said that, within the space, we like Tata Steel. As far as iron and steel companies are concerned, the numbers were pretty strong, and we feel that the growth prospects for the next couple of years are also strong. So definitely the preference in the space would be Tata Steel as compared to Vedanta Iron and Steel.
All right, understood. The next query that we have is from from Lakshmikant over here. We've got a query for Park Hotels. The viewer has asked what is the target price that they can expect in the next 3 to 5 years, and should they average? So they're holding about 200 shares of Park Hotels at an entry price of 160. The stock is currently trading at about 125, 127 levels, and they want to know if this is a good time to average out for a holding period of 3 to 5 years. So I'm going to be looking at Mr. Nirav Vora. What do you think about the stock on a fundamental basis, and is this a good time to average out?
So see, again, we don't have any active coverage on the mentioned stock, that is Park Hotels. But if you look at the overall space, again, we have seen some kind of consolidation happening in the hotel space. That's primarily because of the geopolitical concerns, the Middle East war which is going on, and some kind of footback which we have seen overall as far as traveling is concerned. So, though we are positive on this tourism and travel space from a long-term perspective, let's say 3 to 5 years, but there are selective names in this particular area where we are positive. So, Park Hotels, talking about it, though we don't have any active coverage, but it has a regional presence. It's more in the east. So rather than looking at this particular stock, I would definitely suggest the viewer to switch over to something like ITC Hotels or Indian Hotels, which are much bigger and better brands and hotels in the overall space. Both of them have done pretty well over the last couple of years, and we feel that the growth prospects for both these two are much better than Park Hotels.
Right, so you are recommending a switch to ITC or Indian hotels, but Lakshmikant, a quick take from you, a near-term outlook, or if there's an average strategy that you might want to recommend to Lakshmi.
So near-term outlook, I think it is positive. It has been forming inverted head and shoulder pattern, but breakout has not come yet. I think she can wait for this breakout. Once it crosses up the levels of 135, then we will see acceleration in the buying momentum, and we will see further upside move toward the levels of 155 to 160 kind of range. So keep the stop loss of 118 on the downside, and can wait for this breakout from where it will see renewed strength in its momentum.
Stop loss in mind, and that's going to be the level in concern. But then let's move on. This is a question coming in from Mr. Bharatwaj from Coimbatore. 320 shares of Ambuja Cement. The time horizon is slightly long, and average price is almost 402. He wants to buy more at the current price. The time horizon is 2 to 3 years again. Nirav, do you have Ambuja Cement in your coverage?
Absolutely. Ambuja Cement, definitely, again, if I talk about cement as a space, we have seen a huge consolidation in the space, obviously, because a lot of companies have been doing capex, and though they have done the capex, but overall the demand supply mismatch was clearly visible. Again, talking about Ambuja Cement, it is one of our topics, though we prefer Ultratech Cement ahead of Ambuja Cement, because if you talk about Q1 numbers also, Ultratech Cement numbers were pretty strong, robust, and for FY27, the management has guided 20% revenue growth. Ambuja Cement also, we are waiting for the Q1 numbers. It has also gone through a huge consolidation. But having said that, the capacity expansion is pretty much in place, and we feel that from a 2 to 3 year kind of a time frame, definitely you can accumulate the stock in bits and pieces in, let's say, 2 to 3 tranches. Though it is above your cost price, any correction of 5 to 7% in the stock price will be a good buying opportunity again.
All right, so any correction of 5 to 7% flagged as a good buying opportunity when it comes to Ambuja Cements. But the next query we have coming in is from Dikshita. She's asking if she can average her holdings of ITC Hotels, Bodal Chemicals, and Dabur for the long term. So they've not given a price that they've acquired this at, or even a number of holdings per share. But I guess she just wants a long-term view on these counters. That's ITC Hotels, Bodal Chemicals, and Dabur. Nirav, can you help us with this?
Yeah, so already I have mentioned about ITC Hotels that it is one of our preferred picks. In fact, the Q4 numbers were also pretty strong. So definitely, yes, you can keep accumulating ITC Hotels again anywhere in the range of, if it corrects by 5 to 7%. Talking about Bodal Chemicals, we do not have active coverage on this, so I would not be able to give any fundamental view from a long-term perspective. And the third one was, I guess, Dabur India. So again, Dabur India, if you see, overall FMCG as a pack has not performed well because this year probably we might see a severe El Nino effect, due to which already we are seeing deficit as far as the rainfall is concerned. Till June of 2026, there was a 40% plus deficit as far as rainfall was concerned. But thankfully, pan India, we have seen some monsoon across India, and the deficit has now reduced to almost 10 to 12%. So pretty hopeful that probably in the remaining month of July and overall in August, we might see good amount of monsoon, good rainfall happening, which augurs well for the rural areas as well as tier 2, tier 3 cities, and directly, indirectly beneficial for some of the FMCG names like Dabur. So again, we are waiting for Q1 numbers. We are not expecting very great set of numbers, but again, last 3 to 4 quarters were a little disappointing. But sequentially, we are expecting better numbers as far as Dabur is concerned. So I think at the current market price, you can definitely add from a long-term perspective.
Perfect. Let's move on. This question is coming in from Mr. Sunil Kumar, and he bought RIL at 1300. Now, the strategy that he wants to opt for is he wants to sell this particular counter to buy energy stocks, and for that he wants recommendation for medium to long term. Lakshmikant, I'll start with you. I don't know if a stock like RIL, obviously one needs to have an investment horizon over here, but barring that strategy, anything you might want to recommend for medium to long term, Lakshmikant, at this current market price that can be bought?
See, I think from last few sessions, it has made a bearish kind of candle. So I think until it surpasses the levels of 1,345, 345 to 350, where its previous swing high has also placed, I'm not expecting any big kind of move in Reliance. Although on the lower side, there is a support of 1,250. So I am expecting this consolidation within this band. If it break the hurdle of 1,345, 350, then after we will see upside move in Reliance, which could push it higher on the upside toward the levels of 1,420 to then 1,450. But till it hold to this level, we will remain sideways. Although we have a good support at 1,250, there it will make any kind of reversal pattern. So I think from there we could think to take long position in Reliance.
All right, so that's the view coming in for Reliance. Now, the next query that we have is from Mr. Aftab Alam, coming in from Patna, where the stock that he's holding is PFC, and he's bought these stocks, he's bought 6,700 stocks at an entry price of 434. Now, the advice that he's seeking here is quite generic. He's just written, please advise. But I'll take Mr. Lakshmikant. First, a technical view on this counter. Do you see any further upside from its current levels of 412? Do you see it breaking up through that 434 entry price that is given anytime soon?
So after facing decent amount of correction, stock is showing some sort of stability near its 200 DMA, and from there we have seen a pullback move also. On the higher side, hurdle is placed around the zone of 427 to 430 kind of range. I think if it surpasses this level, then after we will see positive momentum in this stock, and it could move higher toward the levels of 450. So till then, I think we will see further consolidation, and strong support is placed on the levels of 400. So till it hold this support, I think he can carry forward this stock and wait for this breakout. Once it surpasses the levels of 427 to 430, then after we will see big positive upside move in PFC.
All right, so a hold on the stock marked by our technical expert. But Nirav, do you cover PFC as well? What's your view on this counter?
So see, as far as PFC is concerned, definitely I would recommend to hold on to the stock. The primary reason is REC will get merged into PFC, and both the entities collectively will be, only PFC will be listed. The ratio is already, the merger ratio is already out there. It's just that formal approvals are needed, and it might take 3 to 6 months kind of a time frame for the entire merger to eventually happen. But having said that, if you look at the collective market cap of the merged entity, will be to the north of almost 2 lakhs, which itself will be very, very, useful going ahead, because overall, if you look at the power demand in India, is definitely here to stay. As I mentioned some time back also, that El Nino this year can be little severe, adding to the additional power demand, which has been increasing over the last 3 to 4 years. Plus the AI and data center demand and the inclination of India towards that will also add to the additional power demand. And for that purpose, I think PFC, REC, all these NBFCs will play a very, very important role going forward. So I'm sure the counter is going through a consolidation, but from a long-term perspective, definitely hold on, because the dividend yield is also to the north of 5%.
Right, I think with that, thank you so much, both of you, for taking your time out and helping our viewers with their stock-specific questions today.
Thank you.
But for our viewers, it's time for a short break, and post that, we'll be talking to India Mart management. So stay tuned, and more on the markets coming up.
Good morning and welcome back to Buy Now, Sell Now. And we've got another management lined up for you over here on the back of their first quarter performance. We've got India Mart, which has reported its first quarter numbers, and revenue for the company have come up 11.3%. EBITDA seen a gap up of 9.4%. Margins as well at 35.1% versus 35.8% in the previous year. So flattish on the margins, but profit has seen a gap up of 12%. And we have on board with us Mr. Dinesh Agarwal, founder and CEO of India Mart, here to break down the numbers with us. Mr. Agarwal, hello and welcome. First of all, sir, paid suppliers additions have remained weak despite the multiple initiatives that the company has taken. What concrete actions are being taken to improve gross additions and in turn reduce silver tier churn? By what time do you expect visible improvement in this?
See, we have been taking multiple initiatives. We have improved the quality of buy leads and inquiries. We have put up better buyer verification. And despite that, the silver churn remains elevated. And we do not intend to press paddle on the more acquisition until the churn is fixed. So that is what is taking time, and we continue to work towards it. I cannot guide you when can we start seeing uptick on that.
Right. Talking about gold and platinum subscribers, that's definitely continue to performing well. But do you expect premium subscribers to contribute a larger share of revenue going forward?
See, currently it has been inching up slowly and slowly from 60-65% to now 70-75%, upwards of 75%. Since the customer mix is more or less stagnant, that is why we are not seeing more uptick, but otherwise it will continue to remain in the same range.
Right, Mr. Agarwal. ARPU as well has supported revenue growth, and this is despite a largely stagnant paid supplier base. Can you tell us how much further pricing-led growth is achievable?
We have been historically having anywhere between 5 to 10% ARPU growth. And that ARPU growth is a mixture of price increase as well as the upsell that comes from the silver to gold. Since the silver customers are remaining stagnant, and that is why you are continuing to see ARPU-led growth. Once the customer bases start to increase, you will see both coming from ARPU as well as the customer addition.
With AI-powered search and LLMs changing user behavior, how is India Mart adapting its platform to remain relevant and protect inquiry volumes?
See, AI-powered search is emerging, and slowly, Google itself is adopting AI-powered search on the google.com main search. So over the time, whether people will move 100% to the AI or it will become a hybrid search platform just like Google AI overview, that needs to be seen, and we continue to monitor. See, at the end of the day, if our content is valuable, if our matchmaking is valuable, whether it is AI or whether it is search engine, they will continue to drive traffic to us.
Understood. Also tell us, should the current EBITDA levels be considered sustainable despite the ongoing investments in AI and new initiatives?
See, we have been guiding that the current on the standalone side, the EBITDA margin should be taken on a yearly basis because quarter on quarter there is could be fluctuations. Fourth quarter is lower and first quarter is higher. On an overall basis, we have been guiding that it could be 33% plus minus 1 or 2% here and there.
And looking ahead, where do you see the largest growth opportunity over the next 2 to 3 years? AI-led offerings, fintech, business-enabled SaaS, or a recovery in the core marketplace business?
See, core marketplace remains the mothership, and that generates the 90% of the revenue as well as the most of the profit is coming. So I think these are not either or. The core marketplace will continue to have the network effect and community effect, and we will continue to because that is the horizontal platform that brings the traffic and millions of buyers and sellers are benefiting through that. While the other initiatives like SaaS enablement as well as AI-led initiatives, they are slowly becoming significant. So, for example, Busy is now becoming a little significant, but those will take time to become a significant portion of our business.
All right, and thank you, Mr. Agarwal, for taking the time to speak with us. But with that, viewers, it's a wrap on this edition of Buy Now, Sell Now. Do stay tuned to ET Now for more news and updates coming your way.